Good afternoon and welcome back to ABG Sundal Collier's Investor Days. My name is Benjamin Wallstedt. I am an equity research analyst covering the retail sector working from the Stockholm office. With me today to present Fiskars Group is company CEO Jussi Siitonen. So Jussi, the floor is yours.
Thank you, Benjamin, and hello everyone. Greetings from Helsinki. So in the next 20 minutes, I will walk you through what is Fiskars all about, focusing very much on our growth strategy we initiated a year ago in November, then going through also how we see the near future here, and then it's all about Q&A after that one. If we move to the next page, please. So Fiskars is all about strong brand portfolio. We call is a global home of design-driven brands for indoor and then for outdoor living. We have one brand which is very much for outdoor. The company was established already 1648. 48. So we are almost 375 years old. In 2 years' time, we have our 375th anniversary. We are very much focusing on premium brands. The new strategy is highlighting the must-win brands what we have in our portfolio, the countries where we believe that we can continue growing faster organically. So I would like to highlight that this is a company for organic growth. We have more than 350 own stores, so we are very much focusing on direct consumer, both retail and e-commerce. They are already now roughly 20% of our business, and we see that those are the ones which are providing most of the growth in the near future. Moving to the next page, it's pretty much our brand portfolio. And you can see quite well-known brands there. Of course, Fiskars as a brand is the biggest part of the company, a bit less than 40%. And then the luxury brands like Royal Copenhagen, Wedgwood, Waterford are part of our portfolio. Then brands with some better known in Nordic, like Iittala, Arabia, Hackman, and Rörstrand are also part of our portfolio. As you can see, we have plenty of the brands. However, we have identified a handful of brands which are the must-win brands, and I will walk them through a bit later. On the next page, you can see how the business is structured. So we have three main categories, main business area here. We call them Vita, Terra, and Crea. Vita is very much focusing on tableware, drinkware, and interior. So that's what we have highlighted, that we are a high premium brand company, and you can see the brands what we have here, Royal Copenhagen, Wedgwood being number one and number two brands in China, in those categories where we are playing. Wedgwood is the brand in UK as a part of the royal family there, as well as Royal Copenhagen is the brand here in Nordic. This is the biggest, fastest growing business what we have in our portfolio with a bit more than 40% share of total sales. Then two more categories, Terra and Crea, they are more functional businesses. Terra is very much focusing on gardening and outdoor products there. Also watering is included in the business, but it's a smaller share. And then Crea, which is very much scissors, creating and cooking. So those orange Fiskars scissors are our world-known products in our portfolio, and they are here in Crea category. Moving to the next page, and this is highlighting why we call us being a company in transformation. So when we started to set up a new strategy, we were very much focusing on growth, and the reason for that was that we had a long period of no growth there. Top line we were quite stable. We were there on a low single-digit type of growth. Profitability was at okayish level. We were there double-digit EBIT at certain point, but then especially when we started to figure out that actually our cost base is not developing the way we like it, and our gross margins are not the level they should be for the branded good companies, we started to change the strategy. The management, the leadership of the company was changed. Our CEO, Natalie Ahlström, she started a couple of years ago. I started a year ago. My background is in consumer goods business in a company called Amesports there. And with the leadership team, we started to transform the company for more towards growth focused rather than just keeping the business a very stable way. What we identified is the company logic, where we are focusing, where we need to win. We identified transformation levers and then enablers, how we see we can deliver the targeted growth. If we go to the next page, please. You can see here the logic what we have. So we are focusing on winning brands. The winning brands are Royal Copenhagen, Fiskars, Moomin by Arabia, Gerber, and Iittala. As you can see, many of those brands are very Nordic focused. However, we see that they have a lot of potential also being a truly global brands. For example, Royal Copenhagen is the brand which is growing fastest now in China instead of Europe. So those brands are identified as must-win brands because the potential for organic growth globally is the most significant in those brands. Channels, as I already mentioned, direct consumer, both own retail and own e-commerce, they are only 20% of our sales. We believe that in the next couple of years, the company growth is mainly coming from those channels, own retail, own e-commerce. Whilst the wholesale, we see that that's steadily declining in the industry overall. And then the countries, we have identified 6 winning countries. USA being the biggest country for us. So USA is 1/3 of the whole company sales. Then China is the fastest growing country for the company. For example, year to date, September, we were over 30% growth, despite those lockdowns what we have seen, especially in Shanghai area. And then the 4 more established countries, Finland, Sweden, Denmark, are country 2, 3, and 4 in our portfolio. Both are there, give or take, roughly 100 million type of countries. We see that we still have a lot of potential growing in those countries, despite that we already have a quite good footprint in those countries. And then Germany, in Central Europe, especially in gardening, we have identified a country where we have a lot of opportunities. Then the transformation levers, I already tackled the direct-to-consumer, US and China there. One extremely important for us is commercial excellence. And it might sound a bit trivial type of topics here, but bearing in mind where the company is coming from, we see that we still have a lot of untapped potential there when it comes to in-store excellence, when it comes to channel right assortment, when it comes to good, better, best pricing, being more selective with our distribution, and bearing in mind that we are the branded food company, we can price out our product much better way than we have done in the past. Of course, the existing business environment is not very much supportive for this one, but still we have succeeded to increase prices, even though there has been a certain supply chain challenges in these businesses. So these are the ones where we believe are transforming the company. I would like to highlight one enabler what we have here, and that's digital. So we have invested quite significantly in digital when it comes to advanced analytics, when it comes to digital capabilities there in marketing. And those are the ones which are not only supporting our own e-commerce or retail or D2C overall, but they are also supporting our wholesale customers there, what we can offer where we see that there's a now demand in our own channels, and then can provide that information also to our wholesale partners. So digital is the one where we have invested mostly in the past quarters. Moving then to slide number 9, which is part of our strategy. Still one, please. Yeah. One slide. Yeah, this still, if you go to the financial KPIs, this one, thank you. So together with the strategy, we updated also our financial targets. So that instead of having a quite general type of targets, we try to be very specific. So that on net sales, the current target is to grow organically, mid-single digit year after year. So we are targeting roughly 5% growth there. last year. In 2021, we overperformed this target quite nicely with 14% growth. And still, in the last 12 months, a rolling basis, end of September, we were over 5% growth at 8% level. On EBIT, the target what we have set for the company is to deliver roughly 15% EBIT by end of 2025, so that it's not a hockey stick, all the improvements coming on very late in this period. But we have said that improvement should come steadily there year after year. That would mean roughly 50 basis point improvement until 2025. You can see that we improved profitability quite nicely in 2021, 250 basis point from previous years. This year, on last 12-month basis, we are coming up slightly down, mainly due to this inflationary impact what we have seen there in our raw materials, and we haven't yet been fully able to price it out. The actions have been in place. We have seen already quite let's say positive impact there, especially in Q3. We got gross margins up versus last year, but of course, when we take rolling 12 months, we are not yet benefiting fully on those efforts. Then the one thing which has been mainly consumer goods type of companies challenge this year is the cash flow. Our cash flow, free cash flow for the first 9 months, and if we take last 12 months rolling, has been negative due to the fact that inventory levels has peaked out. That's especially the case in USA, but we have also seen that happening in Europe. In the past, you can see that the target what we have set for the company, free cash flow net profit ratio, we have been well above that one. This year, already now we can say that we are not meeting the targets. The good thing, however, is that the company has very strong balance sheet. So our net debt EBITDA target of being max 2.5x, we have been well below that one in the past few years, so that in early this year, we were almost net debt negative there. Now we have funded our organic business, mainly working capital here, and therefore you can see that now we are at level of 1.8x. We are pretty confident in the financial targets we have set the company. Mostly, we have been challenged by our EBIT targets, how we can improve profitability from current roughly 12% level all the way up to 15% in next couple of years. The arguments are very much focusing then on commercial excellence. We see that we have potential there for gross margin improvement. And that's actually something I can demonstrate more if you go back on page number 5, where we are saying that we are transforming the profile of the company. If possibility to move back to that slide, slide number 5. Thank you, this one. So here you can see the gross margin curve in the middle. So currently we are there at 44.6%. We see that our P&L structure, bearing in mind how much we can continue growing in own retail, which of course is very high price point product for us in terms of gross margin, we believe that our right P&L structure would be so that gross margins are there at level of 48-49%. Then operating expenses there at level of 33 something, where we are actually at the moment. So you can see that the strategy is built on a gross margin improvement rather than continuous cost cutting. And we consider that being a way to sustainably run the business so that we are running it through gross margins rather than making this kind of cost cutting every now and then, because those are not the ones which are feeding the organic growth that we have for the company. Then moving more on daily topics, and if you go please to slide number 16, where we are talking about our short-term. Thank you, this one. So what we have said is that when it comes to our own investments, which are totally in our own hands, we are talking investment in digital, we are talking investments in D2C. We continue with those investments. That's the plan. Then the strategic focus area and transformation levers, they are delivering results. If they are not yet fully visible in the numbers, for example, commercial excellence there on gross margins, we can see that on long term, they are delivering the results. And now, even if we take past couple of months, we see that the price increases we have implemented, the new joint business plan we have put together with our big customers, they are delivering the results. We had a good period of 9 consecutive growth quarter in a row. Q3 this year was flat. And we see that this kind of challenging environmental things like continuous inflation, like supply chain challenges, that will continue. We have split the world into 3 different parts. So when we are now planning for next year and for the coming quarters, we believe that in USA, the first half next year will be very challenging. Then the second half, we believe that we start seeing some positive turn so that even growth can be reignited in USA for the second half 2023. When it comes to Asia, especially in China, we have seen the current trend continuing, and the building blocks what we have behind for that growth, especially relating to Royal Copenhagen brand, Westwood brand, how we can continue growing there with our own retail, gives us confidence to continue delivering strong double-digit growth also next year in China. As said, for the first 9 months this year, we are over 30% growth with our China business. It's quite small. We are talking about business which is roughly 4% of the company sales. It's all about Vita business. And then last but not least, Europe. In Europe, especially here in Nordic, we see no improvement whatsoever for 2023. So we are planning against very flat top line. We are planning against continuous inflationary impacts here. And still we believe that we have potential also in our home markets here in Denmark, Sweden, and Finland. That's very briefly my short opening here, and now I'm ready for Q&A.
Perfect. Thank you very much, Jussi, for that presentation. So Fiskars obviously has a very long history. You mentioned a 350-year anniversary coming up. Over that time period, what have you learned about consumer behavior in tougher times?
Yeah, if we consider tougher times, for example, 2020 COVID period here, we admittedly got some tailwinds from that market, because then everything relating to home, relating to this environment where you were able to live in COVID times, you wanted to invest in those. And we got some tailwinds there, especially when it comes to Vita business, home glassware, tableware, home decorations and the likes, as well as when it comes to your backyard, gardening and the likes. So we got some tailwinds there. The good thing is that now we have demonstrated that we can continue growing also in post-COVID time. And then when it comes to this kind of things that consumer sentiment is a bit gloomy, and inflationary impacts are there. What we have seen in the past is typically, even though we are talking about luxury product, premium product in our portfolio, we are anyhow not talking about this kind of high price point product. We are not talking about cars. We are not talking about that kind of things. So we still see consumer buying these kind of products. In gloomy times, you want to build something nice around you, and our products are very good in that one. When I've been talking with my colleagues, having been longer in this industry and this company, they have said that typically this kind of recessionary type of times, we haven't suffered so much there because we are not in that kind of high price point product.
Perfect. Thank you very much. You also hinted that there is a working capital build-up, and I believe that is true for your customers, the retailers as well. How do you think about the high retailer inventory levels going into 2023, please?
This is a very interesting topic, and as I said, when we split world to the 3 parts, that was very much wholesale. The good thing is that even at the moment when the retailers' inventory levels are picking up, and now I'm talking about big boxes, especially in US, Home Depot, Amazon, Walmart type of things, the Targets, which are all our customers. There we see that retailers, they are running their business now against cash flow. So they are trying to get rid of inventories. We are expecting also quite high promotional period there early next year when they are trying to get the inventories melting down. The good thing is that the end consumer, and we have pretty good grip on end consumer there due to the fact that we have quite wide own retail network. The end consumer is alive and buying, and that helps us also to navigate through this one. So it's this middle layer now who are suffering and running business against cash flow.
Perfect. And coming back to that middle layer, as you call them, obviously one of your strategic pillars is moving more towards direct sales. How do you avoid getting pushback from retailers when you sort of steal their market, so to speak?
That's, and I said, it's only 20% of our current sales at the moment. So 80% is still coming from other businesses. This 20% is mainly in our Vita, which means that in Vita business, it's much more. We are talking about more than 1/3, even 40% of their business coming from D2C. Still, in more functional categories, big boxes are the ones which are selling our gardening products, our outdoor products, and the likes. We are in pretty good I would say we are in very good collaborations with our retailers at the moment, due to the fact that all what we have done with our commercial excellence, channel right assortment there, that only the certain products are available in our stores. We make sure that customer profile, customer selection is valid, so that we are not jeopardizing their business with our offering. And always the same product what we are selling there are not typically cheaper in our stores. So it's all the other arguments there. In-store excellence, what else we can offer on top of that? Do we have models which are only available in our D2C? And this kind of channel right assortment approach is the one which has made it quite easy to live with our retail customers at the same time when we continue increasing our own D2C.
Perfect. Another trend that I hear about when I talk to you and other customers, brand owners tend to be more careful about who they distribute their products to nowadays. There are brand risks from discounting, for example. How does Fiskars think about that issue?
Yeah, we are especially in that same trend. We are getting more and more carefully with our retail customers there, what they can sell, what's the product structure there. The good thing is that we have quite wide brand portfolio. So we can also use our tactical brands in certain channels. And of course, then they can go to the lower price point. But what is very important for us is that the brands which are available in our own D2C, our retail customers can't go to the same categories with the only strategy of being at discount mode. That's what we need to be very careful. We are ready to clean the pipeline, clean our customer base, so that terms and concept and joint business plans, what we have in place with our retail customers, are valid and they are supporting our brands.
Perfect. Thank you very much. With that, I believe it is now time to wrap up. So I would like to thank you, Jussi, for participating today, and you guys for attending. Thank you very much.
Thank you.